Okay, so for a second consecutive week, we finished a lot better than we started. The weakness of the week has occurred on Mondays, and the strengths of the week occurred on Fridays, and that's a relatively good sign. So I'm going to break down what other signs suggest what we might see in stocks here going into next week. A very big week from a Fed standpoint. A lot of Fed speak, a lot of expectations of Fed cuts and rate cuts and things like that coming out next week. So we're going to talk about that as well, and what macro things are driving, and what the economics picture is looking like, how that can impact investor sentiment. And finally, we're going to finish with a trade idea, with a high probability trade idea, with a stock that's got an established trend despite the fact that we've had a little bit of bout of volatility. And we'll take advantage of that established trend with a high probability trade. So let's go ahead and get started. Today is Friday, August the 16th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far into the video today, I did want to point out a couple of things related here. When you look at our calendar, again, you just go to MarketScholars.com, click on Trading Rooms. Today's technical analysis class, I did a little bit of a tutorial type video on the market forecast indicator, which I use in these videos quite a bit. We looked at, I even created a scan on the Thinkorswim platform to look for different types of stocks. So you get access, you can watch that class. Any of you can watch that class. You just have to subscribe to, you can see above the video here on our blog, subscribe to our monthly plus plan. You get 7 days free trial for that. And there's you go to pricing to see what our plans are, but make sure it's the monthly plus plan. You get access to that technical analysis class, as well as all the other recordings that we have on the calendar. You also get access to Brandon's Dividend Growth Investing class, one of our probably the most popular class we have here on Tuesday mornings, as well as all the recordings previous for that. So make sure you check that out. Also, if you notice here on the blog, this will be going live here next week as well. I've been testing out this week. It's the Market Outlook live video that gets put out there at 3:30 p.m. Eastern Time. Again, that is also available for Plus subscribers. So that would be part of your free trial, as well as access to those videos. In those videos, we cover the trades that we've made in past videos and managing those trades to their completion, so we can kind of keep track of those, and you can get that educational value of the trade from beginning to end, of all the trade ideas that we do in these videos at the end. All right, to the chart. So you can see today we had a nice little rally. In fact, we've kind of hit this little support level on the Fibonacci retracement, the bottom of the Fibonacci retracement, twice now in the past couple of weeks. First last Monday, and then today here this week on Wednesday. Both of them pretty decent sized down days with opening gaps to the downside, closing at the lows of the day, volatility closing at the highs of their day. We got a Harami reversal pattern there today, or last week. We had a Morning Star reversal pattern here this week. So, in fact, I kind of break those down in today's class as well, and why they're significant. Obviously, we're not out of the woods yet. A little bit of a double bottom potential pattern forming here with the top in between. But getting out and staying out. See, the last few times we got outside of the retracement zone, we got right back into it. So getting out and staying out is going to be significant, as well as getting that intermediate line turning back up above 50 and getting it back above the moving average, right? Those are the other, that's the pattern. Right now, we actually have a bearish pattern. We have a dark pink shading in the red line. We have falling market sentiment too, but that just adds to the significance once you get below 50. And, generally that means we're kind of in bear market territory. And obviously we're not that's not nearly the case right now. But a nice good rally up to the open, right? So we didn't quite fill in the gap. Excuse me. We didn't quite fill in the gap. But you notice kind of why we stopped where we did. It is the old Fibonacci fan of that same, the retracement levels. We did hit the fan there after having broken through it. So we'll see if we end up getting up above it here. If I were to edit the properties, and then put in, what is that, that 78% Fibonacci retracement or level. Not as significant of a level as obviously the main three are, at least the main two. I mean, there's your retracement level, the zone between the 38 and the 62. The 50 is just a midpoint. This is a little bit bigger of a retracement zone, with the bottom of it being down here at the 78 percentile. So we bounced off of that, but now we're back into the kind of the main zone, using it as resistance. You also have this volume node, the point of control volume node, that's also acting as a resistance. So we'll see if we end up getting through a little bit today. We have a big, our Bollinger bandwidth is as high as it was during this last little bounce off of the previous intermediate pullback. So that you would expect now that bandwidth is going to start pulling back down. Usually it does that as we move to the upside. The bandwidth pulls back down to the downside, and we'll see if the stocks kind of follow that same pattern as well. You take a look back in the market forecast indicator. The near-term line and the momentum line both bounced back up into the upper half of the chart. The near-term line did dip a little bit into the lower reversal zone. That's not, that's bearish. That's why we pulled back, especially with the extreme oversold momentum line. So that's there is that possibility we can get a lot more bearish if we were to break the support. So keep, that's the inflection point. That's something to watch into next week. I personally don't expect that to happen. I expect the support to hold until it doesn't. But if it does, obviously we'd adjust. We'd adjust and move, adjust accordingly. If you look at the Dow Jones Industrial Average, its intermediate line also is almost to an oversold level. There's that same Morningstar candlestick pattern with the bounce in short-term sentiment. QQQ, same pattern as you see on the S&P 500. And then finally the the Russell 2000 with that same reversal pattern there, coming off of a oversold cluster. So that's a significant signal. Again, you're not too oversold too often. You are more often on the Russell than the S&P just because of its higher beta attributes. But an oversold cluster might be the signal that, similar to the clusters we had over here, at the end of that intermediate pullback, that we are now at the end of this intermediate pullback, especially considering as of right now, they're stopping pretty much at the same level, right around 1460. All right, again, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video that notifies you when these videos are posted. Also, hit the thumbs up icon down below the video. That tells me two things. Number one, you got something out of our video today. Number two, that you want us to do it again Monday. So if you like these videos, if you want us to do it again, you can tell us really quickly, and you can do it right now with one click. Just hit that thumbs up. That's a big deal for us. That's how we get our feedback from you. It's also how it's a big deal for YouTube as they promote videos with that type of engagement. So we really appreciate that. Comment down below on anything that you got out of the video today. When people come to videos, they check out the comments, see what people are saying about it. So what did you get out of the video? Let others know, and in that comment section below. And join our join our daily market outlook email list. There's a link right there in the top right corner of your screen. Click up on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day, and join our market outlook community that we've created on Facebook. Really quickly, we also invite you here to engage with us on social media, on Twitter and Facebook specifically. So down below the video in our blog, you can see that there's tonight's Market Outlook post or tweet and the Facebook posts. Again, the more you engage with them, the more Twitter and Facebook will put our content at the top of your timelines. That's how you let them know that you like our content, you want to see our content. So the more you engage, we try to make it really easy for you to engage with us. Just hit this heart. We did get above 108. Let's see if we can get above 150. I know there's plenty of you that watch these videos, so just click on that heart and then hit that like button. And the same thing with Facebook. Click on this image. It takes you to your Facebook page. Again, very much appreciated for us. It's a big deal for us, but it also is a benefit to you as they will make sure to put our content and any other content you engage with at the top of your timelines. All right, back to the charts. And you can see this is an interesting weekly chart. If you look at the regular candles, 2 weeks in a row of long lower shadows. Those are bullish signs. In fact, kind of flirting with the 200-day moving average. It would have been kind of nice, actually, if we would have closed below the 200-day moving average, because then we're more likely to get that kind of a bounce, as we saw back in June. But regardless, getting long lower shadows at the 200-day moving average is also bullish, and that's what we're getting here. So, in fact, if you look back in the Heikin-Ashi candle, if you look at the difference, the gap here between the open, let's see, 29.38, 95. Oops, that's not what I wanted. 29.38, 95 plus the close. The midpoint, so which would be the open for next week's candle, Heikin-Ashi candle, is 29.15, just over 29.15. We closed this week at 28.88, so it's only 12, 15 points, 27 points away. We traded up 41 points today, so that's not very far. And if again, to get up to that level, to get up to up above the open, and obviously depending upon where we open Monday, we'll be trading below it. If you get both a lower shadow and an upper shadow, similar to this, that's your transition candle, right? That's the candle that leads to a bullish bounce in a new intermediate run. This intermediate run lasted 7 weeks. So the typical intermediate run lasts 1 to 3 months. So we're looking at 4 to 13 weeks. So that's the kind of candle we'll look for here next week. Otherwise, again, closing at or below the 200-day moving average, especially in a golden cross environment like this, can be a relatively bullish sign then too. So there's still going to be some trading towards the lows of next week. Considering the reversal, or the past 2 weeks, considering the reversal patterns we've gotten both of these weeks at that same level at those lows, a good sign that we've had that bounce, right? We've tested that range and we're looking now for a move back to the upside. Let's take a look at the 3 green arrows, and you can see we have 3 red arrows still with a falling moving average. So like the market forecast, still bearish patterns. So that's why, don't put all your eggs in the bull basket, right? Just build positions similar to how you saw back here by the time we finally got the bullish bounce and the reversal back then. If you look at the 2-line versions, we're not even above the 8-day moving average. So all we did with this bounce today is got back to the 8-day moving average. So getting through it, and especially getting up above the 17-day, is kind of like that next stage we need to see. Because we have closed above the 8-day a couple times. We need to close above the 17-day. That generally leads to the reversal that we need, that we're looking for. And obviously the MACD will move up. It typically moves up pretty quickly from below 0 to up above 0. And we're not even above the moving average yet. So if this is indeed a bounce, if we are in the midst of a reversal, we're in the very, very, very early stages of it. All right, when you look at the intraday chart, again, we actually did a really good in terms of getting up to this little node right here. I thought that's kind of where we'd peak today if we were going to continue this rally. And we actually got up through it a little bit and got up above it. You can see that we still got some resistance again at 292.5, and if we were going to get up there here this week, that's also right about where last week's high point is. So it's not going to be clear sailings, but you can see again that same vacuum of volume that's existed that caused pretty much the gaps to the downside and the quick moves back to the upside to fill them. There's a gap right there, so this would be the 3rd gap through that same area. The last 2 gaps got filled, and it took 1 day here. It took 1, 2, 3, 4 days here. For that 4th day would be Monday here. So I wouldn't be surprised, not because it was exactly 4 days, but because I expect that gap to get filled, and they generally get filled sooner rather than later when they're common gaps like that. And especially with that lack of volume, you've got less volume above where we're at than we do below where we're at. So that means that there's a good sign that we might switch and make a move up as early as Monday up towards that 292.5 level. Then we'll have another battle again. We had a battle there. We couldn't, and the Bears won again. The Bears won. We got up there, and the Bears won the battle first. The Bears won it again, and we'll see if the Bulls will be able to overpower and get through that volume node on the third go around. See if the third time's the charm. Let's take a look at the volume and the trading range here. You can see today's trading range at well, let's go to SPY. The trading range there. Now keep in mind, let's see, we close at 284.65, the low at 284.71, so a smidgen of a gap there. So the range at 462, a little bit more than that, probably 467, 470, a little bit above the average. The average is higher than it has been. Volume at 85.8 million. You can see it's also just a smidgen above the average. The average down here is at 89. It's actually a little bit below it. And the volume, the trading range is a little bit above that. So that's actually a good sign, right? And you don't want big time moves, right? Big gaps to the upside. When you have big moves to the upside and the downside and then the upside, then you get this, right? That's typical of a pullback, right? You get big moves to the downside, 1% plus moves to the downside during these intermediate pullbacks, and you might start off with a relatively larger move to the upside, but then that's it, right? You don't get a whole lot of 1% moves bounce. Otherwise, this is what we get. We don't want, that if you're bullish, you don't want that. So right now, we've had a couple big 2% moves to the downside. We've had one kind of relatively large move to the upside bouncing off of here. And we've had some ups and downs. So that's a little concerning, and we want to see that kind of halt and start getting into like this area below 1%. You can still be above 0.5%, but at 1% or lower, because that means now we're really taking hold, right? You're really getting going. You're taking hold on this. We don't want a lot of big volatile moves. That means the VIX is up. Another positive sign is volatility did drop below historical volatility, and in the past, as you can see, that typically sets the low point for the market. Some of the other examples in this past year. So another good sign that we are in the process of setting the low point currently as we speak. Finally, let's take a look at the VIX closing into the neutral range. Closing down below 20. So we're not, again, you get below 17.5, and now we're making our way back down. So we're not out of the woods, right? Very, very early stages. We have to get below 90% before this bullish intermediate run takes hold. So again, early stages in a lot of these indicators. But the nice thing is the indicators are leaning more towards the beginnings of an intermediate run than they are leaning towards the potential for a prolonged market sentiment pullback, orange line on the market forecast indicator, and not just an intermediate pullback like we got back in May and June, right, where the green line drops below 50 and that's it. So it's leaning more like this an intermediate pullback, and that we are in the process of that intermediate turnaround as we speak. All right, so before we talk about kind of what's driving the price action, different relationships, and today's trade idea, I did want to kind of briefly pause and summarize our technical outlook. So, obviously we've had a little bit of bump in volatility, but we haven't had that surge in volatility where we expect more of a prolonged decline. So it's a typical pullback. We get a few of these every year. I've talked to you before, and every time we do get a 5% pullback, in this case about 6% or so, on a close-to-close basis. It does seem like the world's going to end. Unfortunately, that's just the type of environment we are in. The financial news media is kind of driven by increased volatility. They get more. They do markets in turmoils. They get more viewership as a result, and so it seems a lot more dire than the reality is. We tend to get multiple 5% pullbacks. And we've had a couple of them this year, which is right about on average. Now, whether or not we get a few more, which is a little bit above average, and we've had years like that, remains to be seen. But as of right now, barring what happens with tariffs at the end of the month or any other event risks that we can get by the end of the year, it's looking like we can set up for a decent intermediate run heading into what is typically seasonally a bullish time of year at the end of the year. So what do you think? Again, and if this is that reversal, we are very much in the early stages. Like we're talking like preseason NBA basketball right now. we haven't hit opening night yet. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on what you're seeing. Obviously, everybody's got their opinions, but let me know what you see that would suggest otherwise. Either that but this is not the intermediate reversal, or that that there's even a higher probability of a bounce to the upside than even these early stages suggest right now. All right, now let's break down what's driving the price action here and how we finish up the week. You can see the big bump in risk appetite today. Small cap stocks, really agricultural commodities continues to be such a huge laggard. But small cap stocks rallied, and that's again a reflection of this trade war that we're seeing. Small cap stocks rallied, S&P rallied, developed markets, emerging markets, all were weak performers. They all rallied. You didn't see a commensurate pullback in the risk and the safety trade, right? Bonds did fall a little bit, but not nearly as much as stocks rallied. You can see over here, bonds fell, gold fell. It was down here today. Agricultural commodities still falling, and obviously the VIX, as we already talked about, dropping as much as it did. A pretty broad-based rally as well. Dividend stocks, value stocks outperforming their growth counterparts. Preferred stocks not doing nearly as well relative to the dividend payers. You can also see, again, the S&P lagging behind both the mid caps and small caps. So you like to see, that's broad, right? Those are your biggest categories, compared to the S&P. So it's good to see a lot of participation in this bounce back up today. Another good sign from a broad standpoint. If you look at the foreign markets, again, usually the S&P 500 has kind of been a little bit of a safe haven. It doesn't fall as much as some of these other emerging markets do, or other developed markets even lately. You can see that Turkey and Russia, Argentina rally, but still lagging behind like the S&P 500. Brazil's down there. You can see developed markets as well: Japan, France, UK. There's China also lagging behind, Germany. So your biggest global economies lagging behind both the S&P, or the Russell 2000 up here, and the S&P, and some other smaller developed names and smaller emerging market names other than India leading the way up to the upside. Asian did very well. Finally, Korea, Taiwan, as we saw India as well. That's been kind of a lagging category. And you still have some relative weakness in China and Japan. But it's nice to see kind of the smaller markets in Thailand and Taiwan, and especially Korea, which has been a embattled area, finally doing so well. In fact, you can see over the last 3 months some of the biggest losers over the course, and again, you can see how the S&P is held up pretty well, relatively speaking, compared to some of these other major economies, with only really some small high beta emerging market names being kind of the only outperformers. And then you have your kind of neutral Switzerland stocks, and then Russia up there as well with the US. From an economic standpoint, housing starts did not show a lot of improvement. In fact, kind of came in, as you can see here, at 1.1, came in below the estimates, even with this, and came in below the prior figure. Permits, on the other hand, came in, which are a little bit more leading, right? They came in higher than the estimates and higher than the prior numbers. So good sign from that standpoint, even if the starts themselves didn't jump up. It's been a good week. It's been a good couple of weeks, actually, for economic indicators. Finally getting back up above this -20 level. That's an important threshold for the economic surprise that in the past has led to pretty decent longer term returns. I mean, longer term in terms of 1 year, 2 year type returns. So very, very good sign, even if the rest of the global economic indicators haven't quite caught up, but showing some improvement in the U.S. You can see also the jump up that we've had in GDP estimates, getting back up to 2.2%. Remember, The biggest drawback down on GDP this last quarter was the drawdown in inventories that we've had. And so, that's a cyclical area. So the fact that we are drawing down on inventories, we had an improvement in the last quarter in the consumer demand. And as we've seen with some earnings in other areas, the consumers are still resilient and strong in the face of a lot of dark clouds that are hovering over Wall Street, so to speak. And if you look at the odds for rate hikes, that the odds of a 50 basis point hike has dropped back down, even though I still think that would be your best bet, but to really kind of say, okay, now we're done. But they drop back down, still obviously 100% odds that you get at least one rate hike down the 1 3/4, 2% range. Small odds that you get two. By the end of the year, you have 94% chance of at least one. You only have a 60% chance of two. So that the odds of a second hike, the odds of the third hike are about 60%. So a little bit, probably right about where we were yesterday. So you still got high probability, though it's not baked in the cake, of a third move by the end of the year. And then finally, of course, going out to April, 100% chance we'll get one, 98% chance we'll get two, and you can see 13, we're about 14%. So about 86% chance to get three, and then it gets to be a coin flip after that, right? 50% chance one way or the other. So you got a 50. So coin flip once you get to a little bit more than a coin flip odds that you'll get a fourth one. But pretty decent odds we'll get three into the end of April, in addition to the one we already have had. So that would be 4 cuts during this cycle. And again, the last 2 mid-cycle adjustments, that's a buzzword, is the Fed were 3 cuts. And then they stopped, right? And so we'll see if that ends up being the case this go around, especially considering that even though before, if the odds play out, the fourth one, the very first one, being essentially a reversal of a rate hike that they probably shouldn't have done at the end of last year. So now you say, okay, well, if we just reverse that one move and now we get the mid-cycle adjustment, depending on however those 75 basis points come, whether it's 3 more 25 basis point cuts, a 50 and a 25, they kind of get a little bit of bazooka, so to speak. That's another buzzword, at least in European central bank chatter. We'll see. Our Fed typically, the MO isn't to surprise. They'd like to be very, very transparent. And if we were going to get a 50 basis point cut, you would hear a lot more chatter about it heading into, especially Jackson Hole next week. So next week will be a big central bank week, Fed speak week. So to see what the market pricing in expectations for what the Fed's expected to do going forward from here. From a sector rotation standpoint, not surprising, the S&P, with it being down 1% for the week, that our best performing asset classes were your safety asset classes, the utilities and real estate interest rate sensitive areas up at the top, along with consumer staples. Let me move this over here to our sectors. But you can see, and they've been good performers over the past few months. They've maintained that performance. Energy has been a laggard, and you can see down 3.4% for the week. Nice little rally off of a midday low point here when we hit our lows in the middle, pretty much when Europe closed, or right around when Europe closed yesterday in yesterday's market. If I take a look at just what happened today, very cyclical areas leading the way higher. So there's your S&P. So industrials, technology, financials, materials, all benefiting. Big moves to the upside. On the other end of the spectrum, giving up some gains. I mean, not with losses, right? These are still gains, just not as much as people rotate into some of these more cyclical areas. You can see in the S&P 500, I mean, the GE had one of the biggest moves today, up 10% coming off of that, the allegations of fraud that sent the stock lower previously. Obviously, NVIDIA in the news as well with its earnings announcement. Nice big 7.25% move. to the upside, and lots of discretionary, and a lot of even if Macy's wasn't up here, you see Gap and Foot Locker, some discretionary type trades. You see a lot of industrials up here as well. There's John Deere, some energy, some really oversold energy stocks making their way up to the upside. Halliburton, Schlumberger, a few other big moves. Gap being one of the bigger moves. A lot of extra volume than normal than what you see there. So very, again, risk on type of a day. That's a good sign to see these cyclical areas to the upside. And on the other side of the spectrum, utilities and real estate are your laggards to the downside. And that's, very, very typical. Lots of utilities names in here. Still showing small gains, small losses. But that's your typical type pattern. There's Macy's, one of your bigger losers up to the upside. Applied Materials in the semiconductor space, also with a large move to the downside. So for our trade idea of the day, I want to take a look at a stock here that's showing a renewed trend, a little bit of a breakout here, a highest close that it's had during all this time since we broke down on July the 19th. Right, we haven't closed above those highs, but this is its highest close, getting back above the moving average. So it's not rising, so it's not green yet, but getting dark green shading with the intermediate line moving higher. You can see the near-term line is staying in the upper half of the chart. And getting into the the upper reversal zone. If I look at the 3 green arrow version of this chart for Pepsi, you can see we have 3 green arrows. We don't have a big jump in volume in the last couple of days, but if you take a look at the 2-line version of this chart, we're not quite like the MACD itself has also just crossed above 0. So that's a positive sign. Again, it's when you get above 0, it tends to make its way up. You get this renewed. And nothing's 100%, so we can turn right back around here. But generally speaking, when it's making a run up to the upside through 0, it continues to make a run. And you can see the MACD crossing above 0 means the 8 days crossing the 17, and the next stage would be for both of these to cross up above the 30-day moving average. You can see when earnings is coming up here after September expiration. You look at the Bollinger Bands for Pepsi here, and you can see how we're kind of filling in this little void of volume until we get up to 133. But you can also see even then, again, there's more volume to the downside than there is to the upside. We're above the point of control. We're above the value area. We've got, like I said, in the immediate area, more volume below us and above us. It's kind of like we move towards the path of least resistance here, and according to the volume, that's right now to the upside. You can see that on the DMI, its lines have crossed. You had a crossover, the blue line over the orange line. It's not above 25 yet, so that's why I'm not going to be too aggressively bullish here. I'm still going to look for this to cross, look for that to cross above 25, but there's ways that we can be bullish without being aggressively bullish, right? And that's one of those ways is to sell put options. This is a working order that we put through during our live Market Outlook Live today before the market closed. And you can see, the idea is, and it was just a working order, so it hasn't filled yet. And the reason being is this delta is still at 40. So if I were to sell the 130 and buy the 125, that's where I'm getting more credit than I need. See, the goal on short vertical spreads isn't to get more credit, right? If I was looking for a good return, then I would do a long vertical call option, or I'd buy a call. That's the type of trades I look for returns. Here, I'm not looking for high returns. I'm looking for high probability, considering that you've got a good kind of established trend here. Unlike other stocks that have really pulled back that would give us some directional opportunities to the upside, here we've already got a nice established trend, and let's ride the probability of that trend. So I'm looking at lower credit, gives me a higher probability. I don't want to go too low because then I'm not getting enough reward for my risk. So 30% is a good threshold there, so that's right around $1.16. So we'll give it a little room to work with a stop limit order at $1.20. And we'll set that trade in. And considering again that we're getting some bullish indicators, but not necessarily the like set and everything is right there. We probably don't want to put a full position size on here. But it's also pretty bullish. So I wouldn't cut it in half either. So I would do smaller than normal, but I wouldn't necessarily go all the way down to, like, say, a half a position. I think you can kind of split the difference there somewhere in that 3/4 range, or even, like I said, you can even, if you don't have the alternative, if it's either half or full, then I think here, because of the probabilities and the technical outlook, you do have the opportunity to do a full position, especially considering that earnings event risk is after this expiration date and not before. All right, so that being said, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out there. It goes to our Market Outlook forums on marketscholars.com. Open up any new thread with any questions or comments you have about the video today. Let's keep this conversation going over the weekend. You can also reply to anybody else's thread as well. Again, thanks for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Also, remember to follow me on Twitter for more content in between videos from day to day. Join our community on Facebook as well as on our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.